first. So the first one is course evaluation links are open. You probably received emails regarding those as well. If you're out on Canvas, though, I did move that link up towards the top, so you see the course evaluations link. I did that right before class. So you have until, gosh, I think like the week before finals.
There's quite a bit of time.
Yeah, you have a few weeks. I don't think it says, but it's usually about the week before finals to get that completed. So it'll just be an online. We won't do the in-class course evaluations. So please go out, complete that. Remember, it is anonymous. I don't even see them until after final grades are calculated. So no worries there with anything, right? So the other announcement is I did have a request that we move our project day to the last day next week, like Thursday, and test first to get the test out of the way. So if everyone's okay with that, we'll probably test Tuesday and then have a project day Thursday. Okay.
But are you saying change the due date to the project?
No, we're not changing the due date. We're just having the, I think I had it scheduled Tuesday, we'd have a project day, and Thursday we would test. So we're just going to flip-flop so that we can get the test out of the way and then have a project group day, work day. So yeah, we're just changing the work day. It's not, your due date on your project will remain the same. I'm not moving that. It's due Thursday now. Just kidding. So we'll cover chapter 14 today and Thursday. So any questions on anything before we get started? Yes, the test will be next Tuesday in class. It's just over the one chapter, so it's just over chapter 14. So it's kind of a little break, right? You don't have two chapters to cover and test over. So not too bad.
Then after that test, just the rest of the project?
Yeah, we're down to the end, so we'll just be working on the project the way we've actually knocked things out pretty well. We stayed on a good schedule, so yay. Of course, you know, after Thanksgiving, we only come back for a week and a half before finals. It's so crazy, isn't it? So.
Oh yeah, I have a question.
Sure.
The paper part of the project is due on December 5th. Are we presenting it that day too?
I believe we're just December 10th, or is it the 9th or the 10th? It's that last day of class that we'll do presentations. I made the paper due a little sooner to make sure everyone got it in and you could prepare your presentation.
Okay.
So yeah, good question. So yeah, we'll actually do presentations. I think it's the 10th. Is that right? Yes, that would be right. It's the 10th. It's Tuesday, the last day of class before finals. Yes. Any other questions on schedule or anything? Okay, well, let's get started. The PowerPoint. So chapter 14 is all about analyzing, doing analysis. And of course, I wanted to cover this chapter before you had more group work days, because you probably noticed on your group project you need to do some ratio analysis. So it will help you, right? So financial statement analysis. So we're going to look at both what we call horizontal analysis and vertical analysis on income statements and balance sheets. And then we're going to look at doing some ratio analysis as well, okay? So basically, you know, we already know what are, I just said two of them, right? So I kind of answered my own question. But we know we have the income statement, retained earnings statement, balance sheet, statement of cash flows. So those give us a fairly good picture, right, of what's going on with the company. So remember, who do we prepare financial statements for? Like, who looks at those financial statements? Investors, and what did you say? Internal. Yeah, like with internally, we look at that to make sure that we're on track. But a lot of times they're for investors. What are some other people that might look at our financial statements?
Well, banks.
Banks, good, like lenders. If they're wanting to lend us money, they're interested in seeing how well we're doing. Investors like stockholders. You know, it's important, even just future stockholders, you know, which they're investors as well, look at that information. So if you're not super familiar with accounting, do you think it would be easy to read financial statements and get a good idea of what the company was doing? Yeah, you'd have to know a little bit, right? I mean, you could pull their annual report, but you guys have been pulling annual reports. How easy are those to read? They're long, aren't they?
Yeah.
They're very detailed and long. It's great information, but there's a lot of data in there. So we do this analysis to provide some better information, some easier information to ourselves and to external users like lenders and investors and people like that. So we're going to look at 3 different types of evaluations: liquidity, solvency, and profitability. Okay, so that's how we're going to look at. Again, you know, for creditors, for example, they want to know if we're able to pay our bills on time. So we can show some of these ratios that'll tell them, hey, we actually pay our bills on time, or we have the money to pay our bills. Okay, and obviously profitable. You know, it's important to be profitable in a company. And who's going to care about our profitability?
The people are investors and lenders.
Yeah, exactly. Probably all external users, right? But definitely our investors. They don't want to invest in our company if we're not profitable. Okay, so it's important that we provide these evaluations so that our external users can make good decisions about investing or lending or anything, you know, just helping us out. Okay, so the first one we're going to look at is what we call liquidity. Okay. So basically, this is for short-term creditors. So we're looking at banks and financial institutions that are wanting to lend us money, okay? Well, they're interested in our ability to pay them back, right? So if they're just giving us a short-term loan, they want to make sure we have cash and other assets that can quickly be converted into cash to cover that money, okay? So that's one thing that we'll look at, is being able to show that we either have enough cash or we can get enough cash in short term to pay off those short-term creditors, okay? And then we'll also look at solvency. Solvency is more long-term. So we're looking at when we issue bonds. You know, we talked about bonds and how we owe them for several years, right? We have to pay them interest twice a year, and then the bond could be matured in 20 years. Well, if you took out a bond, if you paid me for a bond, wouldn't you want to make sure that in 20 years you're going to get your principal back, especially if it was a high amount? So for long-term creditors, we're going to look at solvency ratios. That'll show that we're able to pay back long-term debt and that we're able to make those periodic interest payments. Okay. And then, like we talked about, investors, stockholders, are interested in our ability to generate income. So we're going to look at profitability ratios that'll show that we're actually able to take what was given to us, like assets, equity, things like that, and turn it into a profit. So those are our 3 main things that we're going to be doing ratio analysis on. And we'll get into ratio analysis probably at the end part of today and then into Thursday a little bit. But the first thing we're just going to look at is looking at other analytical methods that kind of show us, you know, how we're doing. Well, one thing we can do is we can look at last year and the year before and compare it. Pretty common, right? Have you ever done that with your own budget? Like you look at last month or the month previous or even last year and see, how am I doing? Am I saving money? Am I spending too much money lately? Spending too much? So, gotta reel it back in, right? So, damn Amazon. Right? So we look at that. We look at those comparative balance sheets and income statements that we looked at last chapter when we were doing statement of cash flows. We're going to use in this chapter and look at, well, what was our cash last year and what is it this year? What's the increase or decrease and the percent change? Then we're going to look at, you know, all of that. We're going to do that for our entire balance sheet. Well, that can tell us a lot about what's going on. Are we increasing our net income or are we decreasing it? You know, are we seeing an increase in expenses? That can tell us a little bit, you know, that gives us one piece of the puzzle. Okay. We can also do what we call vertical, that's horizontal analysis, where we're looking at like cash, the change in cash across this year to last year and even further. But we can also do what we call vertical analysis, where we look at everything as a percentage of total assets or total net income or revenues. We do it as revenues. So we can see, well, out of our total revenue, how much of that are we paying in expenses? That's kind of an important evaluation as well, okay? And then furthermore, which you'll do in your group project, I believe, is we can look and compare ourselves to other industry competitors, okay? Because if we look at just our company, it may look like, oh, we're doing okay, or oh, we're doing crappy, but we want to compare to someone else, like Walmart to Target or something. And that way we can see, are we kind of with the competition? Are we better? Are we worse? What can we do? And we'll kind of talk about that. When you're talking about financial statement and ratio analysis, the thing is we have to, and you'll know this when you're doing your group project, it's really important to consider the industry, because some of these ratios, what may be a good ratio for one company may be a bad number for another company, because companies operate differently. We'll talk about, for example, inventory. If we're Walmart, we're probably going to purchase and sell inventory very rapidly, right? It's coming in and going out very quickly. Whereas what if I sold custom computers? Do you think our inventory is coming in and going very quickly? No. So they're going to have different ratios. And so we can't just look at a ratio and be like, oh, it should be 5 or 5% or 20% or whatnot. We have to consider the industry. So in the test and homework, you're really just going to be computing ratios, and you don't need to know you need to know their definition, what they mean. But when you're doing your group project, it's important to kind of go a little further and be able to say, that's a good ratio for this industry. So just keep that in mind when you're doing your group project and you're comparing your companies, you'll be able to see that a little bit more, okay? So hopefully it kind of ties it all together. I talked about all that, so. I get ahead of myself, right? So the first thing we're going to look at, we'll look at this and then we'll go into the practice and do a horizontal analysis, is again, we're going to look at, say, an income statement or a balance sheet. We can do it on both. And we're going to look at the change from one year to the next. Did it increase or decrease? So these are those comparative statements that we looked at last chapter. We even calculated increases and decreases, remember, because we needed that for the statement of cash flows. So now we're just taking it one step further and calculating the percent of increase or decrease. Because sometimes an amount doesn't tell us everything we need to know. Because if it's a small amount, it may seem like a small increase or decrease. But when we put it in a percentage, it makes, it gives it a little more validity. Okay, so for example, here's a comparative balance sheet. And it's just showing across the board what happened from the year 2015 to 2016. 2015, the earlier year, is what we call the base year. Okay, so as you can imagine, we're going to take the current year minus the base year. So current year, 550,000 minus the base year of 533,000. So we saw an increase in current assets of 17,000. Okay, so current year minus the base year. And then to get the percent, we're just going to take that increase and divide it by the base year. Okay, so 17,000 divided by 533,000, we saw a 3.2% increase. So that way you can see not only the numerical increase, but the percent increase. So like, for example, long-term investments decreased 82,500. Well, that was a 46.5% decrease. So that's significant. Okay. And then you can kind of see as you go down, you can look at liabilities. Long-term liabilities also decreased 50%. So we paid off some long-term liabilities, so that's good. Okay, and then we can see the change down here as well. There was no change in stock except for retained earnings increased 30%. So that's a good thing. If we're reducing liabilities and increasing equity, that looks pretty solid. So we can kind of look at this and kind of note some things that are happening in the business. And that's going to be supported by that annual report. If we read through that whole, however many pages, 8 million page document, we'll probably see why. Why did our long-term investments go down? Why did our long-term liabilities go down? Retained earnings went up. You can kind of see that. And then that's just the assets, the schedule of current assets. So we can see, well, current assets went up a total of 3.2%, but here's a breakdown. So cash increased almost 40%. Temporary investments increased 25%. Accounts receivable and inventories both went down a little bit. Okay. They just broke it out into a separate schedule. We can do the same thing on the income statement. So sales, the current year minus the base year. We had an increase of $298,000 in sales, which is a total of almost a 25% increase. That's a good thing, right? We had an increase in sales. Obviously, with that, we had an increase in cost of goods sold, but our gross profit still went up almost 20%. So we could see our cost of goods sold actually went up at a higher rate than sales. So obviously, we're paying more for like materials and overhead, things of that labor. You can kind of see selling expenses went up. But overall, the one we're most interested in, our net income still increased 19%. Okay, so we can kind of see and analyze, and that helps us make decisions. We could look at, well, why did our cost of goods sold go up at a higher proportion than sales? And we could look into that a little more, which this is a good segue when we start managerial accounting in the spring. That's what we'll be doing, right? Megan knows all about that, right? We'll be like, why did our costs go up? We don't know. No, I'm just kidding. So that just kind of helps us, our interest expense doubled. So that would be something we would want to look into. There's just some things we can see on here that kind of glare out at us when we do this. That's just the retained earnings statement. We can do the same thing. So retained earnings increased almost 31%. So it looks pretty good overall. Okay. So that's just the horizontal. So let's do an example on horizontal analysis. You go out and open the chapter 14 practice. Did it just start doing that today? We'll probably have to look at it after class. We'll probably just have to contact Cengage and see what's going on. Okay. So chapter 14, the first one is doing horizontal analysis. So in this one, they just give us the current year and the previous year, and for an income statement. So we're just looking at the income statement. And it wants us to prepare a comparative income statement with horizontal analysis. So we're going to show the change in dollars and then the change in percentage. Okay, so again, these are pretty easy. Make that a little bit bigger. Well, sales, again, when we do the increase or decrease amount, we take the current year minus the previous year, right? So what is do I have an increase or a decrease? Increase, right? We increased what, 280,000? So you always just take the current year minus the previous year, or base year. Okay. So we saw an increase of 280,000. To get the percent increase, you'll take that 280,000 and divide it by the base year, the 2 million. Okay. So 280,000 divided by the 2 million base year. So what percent did the sales increase? 14%. Good. And we'll round, they did tell us to round to 1 decimal, although that one was even. It's always nice. So then we just do the same. If we have an increase in the dollar amount, it should be an increase in the percentage. Okay, those should match up. So cost of goods sold, increase or decrease? Increase, good. And that was what, 210,000? Okay, so cost of goods sold increased 210,000. What percent increase was that? 12%, good. Okay, so again, we just take the total increase of 210,000 and divide by the base year of 1,750,000. So horizontal analysis is pretty easy. You just have to remember, the formula. So gross profit also increased, right? 70,000. 70,000, and that's a 28% increase. So that's pretty good. Our sales were at 14%, but our gross profit was actually at 28%. So that's a good, when I look at that, that tells me my cost of goods sold, I was actually getting lower, even though it showed an increase. It wasn't an increase comparable to the sales. So that's good. Selling expenses, increase or decrease? Increase, good. What, 31,500? 31,500. And what's the percent increase for selling expenses?
25.2.
Very good, 25.2. 25.2. Administrative expenses also went up. That one's easy, right? 22,000. 22,000. And that's a 22% increase. 22% increase. So, selling and administrative were both up. So, of course, your total operating expenses are going to be up as well. Okay. So, total operating expenses increased the total amount there, the 53,500. 53,500. And we divide that by the 225,000 to get 23.8%. 23.8%. Income before income tax. Is it increase or decrease?
Increase.
It's also an increase. Good. And that was what, 16,500? 16,500. And that's a 66% increase. It's pretty substantial. 66% increase. Obviously, our income tax expense is going to be higher because we made more income. You got it. Thank you. So that is an increase of 6,600. 6,600. So our total percent increase for income tax expense was also 66%, which makes sense because we saw a 66% increase in income before tax. And then last, we obviously saw a total increase in net income of 9,900. And that was also a 66% increase. Okay. So on this one, we actually saw all increases. Sales were up, expenses were up, but sometimes there is a correlation there. If we're selling more, bless you, we'll have more expenses related to that. And so that's okay. So overall, though, sales were up 14%, but we saw an increase in net income of 66%. So that was this was a good year compared to last year. Okay. So it says on part B, it says the net income for Winthrop Company increased by 66% between years. The increase was the combined result of an increase or decrease in sales. Increase, good. And a higher or lower percentage in cost of goods sold. Lower.
Increase.
Yep, and a lower percentage increase in cost of goods sold. Okay. So the cost of goods sold increased at a lower or slower or faster rate? Slower, perfect. Thus causing the percentage increase in gross profit to be greater or less than? Greater, good. You guys are great. You got this analysis down, right? We're done. No, I'm just kidding. We wish, right? Any questions on horizontal analysis, though? It's pretty straightforward, isn't it? It's just remembering current year minus base year and then divide by base year to get your percentage.